Module Overview. International Financial Reporting Standard 16. Leases, issued by the International Accounting Standards Board, replaces the older International Accounting Standard 17 and brings a major shift in lease accounting, especially for lessees. The standard introduces a single lessee accounting model, which requires nearly all leases to be recognized on the balance sheet, resulting in the recognition of a right-of-use ROU asset and a lease liability. The primary goal of IFRS 16 is to increase transparency and comparability by providing users of financial statements with a more accurate representation of a company's leasing activities and their financial impact. Scope of IFRS 16. IFRS 16 applies to all leases, including subleases, lessee and lessor accounting. It does not apply to leases for exploration of minerals and similar resources, service concession arrangements, licenses of intellectual property covered under IFRS 15, rights held under licensing agreements, films, patents, trademarks. Definition of a lease. A lease is defined as a contract, or part of a contract, that conveys the right to control the use of an identified asset for a period of time in exchange for consideration. A contract contains a lease if there is an identified asset, physically distinct and not substitutable. The customer controls the use of the asset throughout the period by obtaining substantially all economic benefits from the use, having the right to direct the use of the asset. Lessee accounting model. Under IFRS 16, the lessee is required to recognize a right-of-use ROU asset, a lease liability, initial measurement, lease liability, present value of future lease payments, discounted using the interest rate implicit in the lease or lessee's incremental borrowing rate. Lease payments include fixed payments, variable lease payments linked to index or rate, residual value guarantees, purchase options if likely to be exercised, termination penalties if lease termination is probable. Right-of-use asset, initial amount of lease liability, plus initial direct costs, restoration costs, prepaid lease payments. Subsequent measurement ROU asset is depreciated over lease term, or useful life if ownership transfers. Lease liability is increased by interest and reduced by lease payments. Exemptions, optional for lessees. Short-term leases, less than or equal to 12 months. Low-value assets, e.g. laptops, small office equipment. These can be expensed straight to P&L. Lessor accounting. Lessor accounting remains similar to IAS 17, using a dual model. A. Finance lease substantially transfers risks and rewards. Lessor derecognizes the asset and recognizes net investment in lease, finance income over lease term. B. Operating lease, risks and rewards remain with lessor, asset remains on lessor's balance sheet, lease income recognized on straight-line basis. Lease term and modifications. Lease term includes non-cancelable period plus optional renewal periods, if lessee is reasonably certain to extend. Changes in lease terms, e.g., extensions, reductions, repricing, may lead to modification accounting. Increase in scope and consideration. New lease. Other changes. Remeasure existing lease liability and adjust ROU asset. Depreciation and interest. The ROU asset is depreciated, typically using the straight-line method. The lease liability incurs interest expense, calculated using the effective interest rate method. This results in front-loaded total expenses under IFRS 16, i.e., higher cost in early years compared to later years. Presentation and disclosure statement of financial position. ROU assets separate from owned PPE. Lease liabilities current and non-current portions. Income statement. Depreciation expense. ROU asset. Interest expense. Lease liability. Cash flow statement. Principal portion of lease payments in financing activities. Interest portion based on entity's policy. Short-term, low-value leases in operating activities. Disclosures. Nature of leasing activities. Maturity analysis of lease liabilities. Total cash outflows for leases. Information on ROU assets by class. Case example, lessee accounting, XYZ Ltd enters a 5-year lease for office space at $50,000 per year with no purchase option. XYZ's incremental borrowing rate is 5%. Initial recognition, lease liability, present value of 5 annual payments at 5% approximately 216,500 Romanian lei asset equals $216,500. Each year, depreciation equals $216,500 divided by 5 equals $43,300. Interest equals lease liability times 5%. Lease payment reduces liability.